In this training, I'm going to show you how to boost your profits doing something called swing trading. It's going to blow you away. It's something that I learned over the last 15 years on how to identify with very high probability swing highs and swing lows. In other words, when to buy and when to sell. You've heard the saying, the trend is your friend, ride it until its end, until it reaches its bend. Well, I'm going to show you in a practical manner because this one thing added to what you currently do will change everything. It's a game changer. It's called double time frame momentum, and I'm going to dive straight in because it's such a powerful methodology. What we want to do is identify two time frames. We want the higher time frame and a lower time frame. And I like to use weekly and daily, but it also works for daily and 4 hour, or 4 hour and 1 hour, or 1 hour and a 15-minute chart. We just want a higher time frame and a lower time frame. And we're going to use something called momentum. That is thousands of momentum indicators. By far, my personal favorite is Stochastics RSI, but it also works with MACD, it works with RSI, it works with whatever else you're using, even with moving averages. But I just personally find Stochastics RSI. Now, what I like to wait for before even considering a trade is to make sure that the higher time frame, which is over here, is either at least oversold. This is for a long trade setup. In other words, it's below the 25 line. I'm going to talk about this in more detail as we get a bit further in. Ideally made a bullish reversal, and then the lower time frame makes a bullish reversal. And this is what we call the trigger. Pull the trigger based on your entry strategy, whether it's a one bar high, whether it's a swing high, whatever your entry strategy is. This is a nice filter, not perfect, but a nice filter, and I'm gonna show you exactly how to use it. So we're gonna now pull up. Well, we're gonna talk a bit about Elliott waves because we need to talk about Elliott waves. Elliott waves using the 80-20 rule is the psychology in price patterns. What drives markets? Well, it's buying and selling behavior. And Ralph Nelson Elliott figured out something that was just beautiful. Is by far probably the best thing I've ever come across. I don't know why most people don't use it. I think it's because it's very complicated. So hence the 80-20 rule. We want to use the 20% that is very practical. Fives and threes. And we can see fives and threes. I'm going to show you a crystal clear cut example later on how we use this. It's going to blow you away. So again, markets tend to move in fives and threes. If it's in a bull cycle, the five-way moves to the upside, and then an ABC correction, and then a continuation. So this is an example of a bull cycle. Five-way move to the upside, three-wave correction. It's the most common type of correction. It's called a ABC zigzag, and you'll typically get a continuation of the former trend. In a bear cycle, it's a five-way move to the downside with an ABC correction, and then you typically get a correction or follow through to the downside. And that's what we're looking for to identify. Now, when you can use this in conjunction with momentum, especially if it's double time frame momentum, oh my lord, it's so powerful. I don't know why more people don't use it. It's something that I came across. But again, with Elliott waves, 80-20 rule, we don't need to get paralysis from over-analysis. We want to keep it very, very simple. So I've pulled up a chart of Bitcoin. Now I've zoomed out on Bitcoin. So we're talking about more than a year's worth of data on, I think this is a weekly chart. And what we want to do is we got the momentum indicator at the bottom over here. It's the Stochastics RSI. I'm going to cover the settings with you as well. The most common setting that I use, I'll show you how to do that as well and how to make it look like this because the default doesn't look like this. But the main thing is this down here measures rate of change. It doesn't measure price action. But what you'll find is if you get the settings right, is more often than not, these lows with the crossovers tend to marry up. And that's what we want to focus on and use to our advantage. So I've just drawn these like this, where these marry up. You can see some of them marry up better than others. So this one married up really nicely with this top over here. So in other words, this gives us a clue that we should anticipate a weekly top and some type of move to the downside, especially if it coincides with some type of Elliott wave pattern. So let's just now draw these out as well. Again, just coinciding with price. So this is how we want to use momentum. Hopefully that makes a lot of sense to you. So the momentum indicator that I'm using here at the bottom is called Stochastic RSI. It's a default indicator. Most softwares have it. TradingView has it. So if you want to use it, just go to indicators, search for stochastics, and you'll see the Stochastics RSI. The settings that I most commonly use is 8533. This is what it looks like. Most people ask me this. It's 8533. These are Fibonacci numbers, and it tends to work incredibly well. The other setting that I use is 13855. And again, you want to just use the one that best suits the chart and the price action. By the way, if you're getting value from today, smash up that like button. It means a lot to me. YouTube then recognizes that you're getting value from this, and it will show my content to more people, which I highly, highly appreciate. By the way, also, if you want the stochastics RSI to look like mine does, because the default doesn't look like it, this is what the visual styles look like. These are the colors that I use. It just gives it a really, really nice, clean feel. So what we're going to do next is we are going to zoom in to this part of Bitcoin. This is a Bitcoin chart, by the way. We're going to zoom into this part, and I'm going to show you the weekly chart and the daily chart and how we can use the double time frame momentum in a practical manner combined with Elliott waves. And Elliott waves combined with momentum is so, so powerful. If you also then combine Fibonacci price, it takes it to a whole different level. But let's just now pull up this chart. So what we've got here is at the top, we've got a weekly chart with the weekly momentum. And then at the bottom, we've got a daily chart. It's the same price data. The only difference is in a week, 1 week is represented by a bar. You could also do this as a candlestick. It's the same thing. And the difference with a daily chart is you get 7 bars in a week, right? Now, that's why it looks a bit more choppy. But you'll see it's the same information. And what we want to do is we want to coincide this information on the weekly with the daily. So let's just now do this. So let's just talk through this. So we've got this momentum on the weekly. So this is a trade that we took. This is what I put in my weekly reports. I have some Bitcoin timely reports. And what we wanted to identify was what looked like to be a 1, 2, 3, 4, 5, and then some type of correction. I was actually anticipating the correction to be a bit deeper, but it weren't that deep. But it was definitely an overlapping wave structure, which indicated an end of a correction. But this over here was a massive clue. And then I used that to my advantage. So weekly is a higher time frame, and the momentum was, it was oversold and it made a bull reversal. And then I wanted to coincide that with the next daily bull reversal. And when I got the next daily bull reversal, it was a great signal to either go long or wait for the market to take off. It was very aggressive to take off, and then wait for the next pullback before going long again. Make sense? Hopefully that makes some sense, but let me break it down in a bit more detail. So now what we want to do is look at how does Elliott wave fit into this? Well, is there a clear Elliott wave count? Now again, there's not always a wave count, and we don't want to force wave counts. But when there is a clear wave count, we want to use that information to our advantage. So what we can see here is a nice wave 1, a wave 2, a wave 3, a wave 4, and a wave 5. Typically what occurs after a 5-wave structure is a longer degree correction than any form of correction within that trend. Come again, Jagir. Come again, Jagir. All right. Well, the corrections within the 5-wave structure is actually the wave 2 and the wave 4. So typically after a 5-wave structure, the following correction will typically be bigger in time and price than any former correction within the trend. So we can see this correction was bigger. We can draw it over here. This was bigger than both this, especially in time, and this. So that indicates that there's likely that the correction is going to end. There is also something we can use called Fibonacci time. I covered that in a separate video, which can really add a key piece of information that most people miss. And then we've got our A, B, C structure. There's a couple of different wave counts we can put on this, but the most typical is an ABC structure before a follow through. And then we got the follow through. That is how you get the trend to be your friend or recognize if it's being friendly and then to ride it in that direction. But what I want to show you next is how to draw a price, because we're doing swing trading, right? And if this ends up being, so a 5-wave structure, when you see a 5-wave structure, it typically has a wave count of 1 higher degree and a wave count of 1 lower degree. And on this case, the first 5-wave structure, the higher degree is a wave 1. In other words, it's a wave 5 or a potential wave 5 of a wave 1. This ABC is an ABC of a potential wave 2. So typically, what comes after 2? Well, it's a continuation of the previous trend, which is some type of wave 3, is most common. And what we can do is one of my favorite things to do. I'm going to show you how to do this. Is to draw a time and price target zone for a potential wave 3. Very, very powerful. And more often than not, you'll find that price target is hit. Not always, but more often than not. So I'm going to show you this live. But before I do, make sure you check out my how to make money trading scorecard. It's 3 minutes, yes, no questions, and you'll get a score, an instant score, and your overall score will be based on your risk management skills, what you're applying and what you're not, your technical analysis skills, your personal psychology, but also your trade plan. Some of the 4 key elements to succeed in trading. I'll break it down on what you should look to do based on your score, and then I'm also going to send you a 15-page personalized report so you know what you should start working on to take your trading to the next level. That's free. It's in the link below. Also, when you join my database, you'll get some extra goodies as well. I got a lot planned for you over the months and years to come because trading is a long game. Most people overestimate what they can do short term and underestimate what they can do long term. And if you're going to start looking at the long game, 1 year, 3 years, 10 years and beyond, geez, the compounding effect is second to none. So now let's look at this with Bitcoin. We spoke about this. So let's go to a live chart. I've backdated it to this point over here. And this is what we've drawn. So what we're basically saying is this. So this wave 3 is a wave 3 in this 5-wave structure, right? So now, as we saw after this wave 1, wave 2, wave 3, now we are looking at it on a larger degree. This looks like a wave 1. We look like we have completed a potential wave 2, and we're potentially going to have the next larger degree or wave 3. And this is the most typical common price and time zone. I'm going to show you how I did this. It's really, really powerful with some Fibonacci tools. So let's get rid of these, and I'm going to show you how I did it. And it's a really powerful indicator. It's like my thesis is this is what I'm anticipating will happen. Doesn't mean it will happen. It's just what I'm anticipating. In a separate video, I show you how to do something called double think. I'll show you where to find that video after we just cover this. It's a really, really powerful way of how to think when it comes to trading. So what we're going to use is a tool called Fibonacci or trend-based fib extension. Is an extension tool. And what we're going to do, I'm going to show you what we're going to do. We're going to measure how far did this wave 1 move up, and then from the wave 2 low, project some ratios up in advance. These are leading indicators showing what's likely to happen in the near future based on buying and selling behavior where the fundamentals are already baked in. And again, if you're getting massive value from today, because I'm going to share what I've learned. I spent hundreds of thousands of pounds and thousands of hours over the last 15 years learning this because there's so much noise out there with different types of chart patterns, different types of indicators, different types of strategies. This I found to be the best. So if you're getting value, smash up the like button. And if you want to be notified when I do more content like this, subscribe to the channel and I'm going to deliver for you short, medium, and long term. Because look, you may or may not know, my name is Jagir. I used to be a math teacher. I just got a passion for teaching and imparting knowledge, learning the best methods on the planet for different areas, one of which being trading. And I'm going to teach you that as well. So when we're looking at this, let's do this now on this trend-based fib extension. So we're going to measure this wave 2. I like to do it in line with the wave 2. So we're going to measure this wave 1 and project it from this wave 2 low. And the key ratios that I want for a wave 3, typical wave 3, is actually 1.618. That's the most typical. But we want to be conservative as well. And a conservative number is 100%. In other words, 100% of this move projected from this low is what this number represents. And a typical wave 3 is 1.618 of that. It's a ratio. It's just buying and selling behavior. It just happens time and time again. Now, the next question I want us to ask ourselves is, how long should a wave 3 take? How long? Typical minimum and typical maximum. So this is very cool. You've probably never seen this before because most people, I've never heard anyone else really talk about this, or very few people on this planet, other than the people that I learned this from, is we're going to measure how long did it take for a wave one to form, like literally in time. What we did in price, we're going to now do for time. How long did it take? And we're going to project that forward. And then we're also going to do something called a low to high ratio. Is this low to this low? How long did it take? And we're going to also project that forward. And that's going to give us a time cluster, a time ratio, or time zone, should I say. So this is called, it's called on TradingView, it's called trend-based fib time. So we're going to click on this low to this high, and we're going to click on the low over here. So that gives us our minimum expectation, and we're going to do the same for the low to high. And this is the typical maximum. So I'm just going to have to just zoom in over here. So we just get the ratio. Here it is. Bang. That's our typical zone. And what I personally like to do to make it a nice clear visual is to draw a nice box. And that just gives me a nice indication of what I'm anticipating. And as the market unfolds, what I'm anticipating is this to be some type of 1, 2, 3, 4, 5, some type of correction, some type of wave 3, some type of correction, and then a final 1, 2, 3, 4, 5. That's what I would like to see happen. And I want to make money over here. I want to possibly make money shorting over here if this occurs down here. Definitely want to make money on what's called a wave 3 or wave 3. This can be a very aggressive wave. And I also want to make money on this wave 5 as well. This is the most typical buying and selling ratios that typically occur time and time again. So if you like that video, or if you like today's video, you're absolutely going to love my next video. I'm working on this. It might be available already. It's called Level Up with Risk Management in Trading. It's something called double think. How to think and not get caught out with your cognitive biases, because most people want a certain thing to happen and then they only see the outcome as a possibility. Therefore, risk too much. Don't buy at the right time. Don't sell at the right time. Don't take money off the table. Don't take profits. I'm going to cover that in detail with advanced risk management strategies, but more on how to think. So take that scorecard, like today's video, and I'll see you very soon.